Welcome, everyone. Henry Wheelwright, managing partner and co-founder of Stablepoint Partners, welcoming our clients, friends, and general audience. It's Friday, July 11th. We're in full swing in the summer. July 4th was a scorcher and a great time to be with friends and family, and we just hope you're having a terrific summer. It's been a little while since we've talked about the markets. We're through the mid-year mark, and what a year it has been. We look at where we were 3 months ago. We had the lows in the market in April, Trump tariffs, a lot of volatility, our first true bear market in a while, and voila, 3 months later, we're back at all-time highs. So I'm going to talk about the way Stablepoint is thinking about asset allocation, thinking about some of the macro stories, and then also finish the video talking about what you're going to see from our financial planning team on the big, beautiful bill. So bringing up a slide on the left, uncertainty is not a new thing, whether it was the financial crisis in 08 and 09, certainly the pandemic with COVID, and then you look at tariff volatility. We saw the VIX spike in April to some of those highest levels, very similar to those periods of uncertainty that we had before. We saw all of that really on the backs of fear of a recession, major concerns on supply disruption, some real concerns that we would see as a result of the tariff policies, a spike in inflation, and the Fed not be able to take action. Markets were really unraveling with uncertainty. Our message at that time was to stay focused on your portfolio, your plan, and boy, did it pay off. So let's take a look at where we are now, first from an economic standpoint. If you look at the right-hand side of that chart, we have seen GDP forecasts start to get revised lower, not just in the United States, but across the world, whether it's emerging economies, developed parts of Europe, and the US expectations now are somewhere between 1.8 or 2% GDP growth. So how is the market at an all-time high? I think it's expectations and perspective. What we have seen in the last few weeks is an acknowledgement of three very important items. Number one is GDP revisions have happened, but at a much slower pace, and it certainly appears that a recession is not going to happen in 2025. We do have an economic recession. It's going to be pushed out to 2026, and this has played out in a number of areas globally. So expectations were very, very dire, particularly around tariff policy. And what we've seen is the US economy has been consistently strong in the labor market, consistently strong in consumer spending, despite elevated prices. Elevated prices, inflation, another area that's really tied to the Fed that I'm going to talk about. We've seen CPI numbers, consumer price index numbers, as well as PPI numbers, producer price index numbers, come much lower than many feared or anticipated as a result of the dislocation on Trump tariff policies. Simply put, inflation has been elevated, but guiding closer to that Fed 2% target. And the market's starting to feel pretty good. Hey, not a recession on the horizon. Globally, consumers are in pretty good shape. And then we had earnings. Earnings were terrific for the quarter. And that wasn't across the board. There are some cyclically weak areas in parts of consumer goods, consumer discretionary, autos, I think some holes in housing and housing starts. But generally speaking, the S&P 500 delivered 11% year over year earnings growth. That easily beat the target of 6%. And here at Goldman Sachs, we're starting to raise price targets as a result of the consistency of corporate earnings. Right now, we're expecting anywhere between 7 to 10% higher in the S&P out the next 12 months. And the market has started to really feel like it's on another leg of a bull market run. What could stop that? Tariffs are still here. This last week, a number of letters, public meetings from Donald Trump about focusing back on tariff policies for those many countries that have not negotiated with the United States. We still have an August 1st deadline. And I think that's going to weigh on the markets probably the next few weeks. We're in a gap of economic data. We just finished up earnings. It's summertime, so expect a little bit more volatility. I do want to bring up a slide from our partners at Capital Research Group that talk a bit about tariffs in general and the impact to tariffs. I think really in April, when we saw a pause, a moratorium on some of these deadlines, it became clear that Trump was going to use U.S. tariff trade policies as a negotiating tool. And I think as you see in this chart, it's really had a relatively low impact on the macro story, hasn't really slowed down consumers, and corporations have been out there trying to just meet expectations and guide higher. We've now gone into that second phase on the left, that rebalancing. There's going to be some countries that are going to face significantly high tariffs, those that don't come to the table of the United States. I think the market is really banking on the major economies throughout Europe, Canada, US, Mexico, Vietnam, eventually coming to some terms. And that remains to be seen in permanence, but certainly that will be a focal point of the market. On the right-hand side of this slide, we start to think about the larger impacts of trade policies out the next few years. Will we see a decoupling of supply chains? Certainly that would impact China. I think the narrative between the Asian Pacific Rim and Malaysia, Vietnam had a lot to do with trying to reposition global manufacturing and distribution away from China. And I think if we have a more permanent decoupling in supply chains, that's going to be a little bit more difficult for the markets to absorb, likely lead to some dislocations and higher prices and inflation. So it's something, again, Stablepoint in the market is watching. Last is really funding. We had an early message from Donald Trump and his team about repositioning tariffs to generate actual revenue for the United States, try to cut some of that shortfall and deficit. I think that remains to be seen, but could be a real significant shift. And I'm not sure how we get to the math to it. So again, tariffs are probably a short-term item. Economy has come in better than expected. Earnings and quality of companies have been incredibly strong. And then we have the Fed. So a few weeks ago, we heard from Jerome Powell, and the narrative has begun to shift, not just from the Federal Open Market Committee members, but in general, the market has said, hey, September might be the first rate cut. As you look at this chart that I bring up on the right, expectations on where Fed policy and Fed rates are going to be have been all over the map over the last year. Initially, we anticipated a year ago 4 or 5 cuts by now. Then we began to see a strong labor market, trade policy push those out. I think our expectations now are if the labor market continues to be this consistent and strong, we'll get at least 2 Fed rate cuts this year, starting potentially as early as September. And then we may have some follow-through cuts in the following year in 2026. If you look at Goldman Sachs's forecast for the S&P 500 and where earnings are headed, a lot of that has to do with what we call this Goldilocks scenario, this fairy tale scenario where you have strong consumer spending, a very healthy labor market with unemployment around that 4% range. And then you also see margins in the 20% range and staying wide for many companies. So why are margins so good? Why has the market also gotten into an all-time high as we head into the summer months? The NASDAQ technology AI trade. We have continued to see the focus on capital spending, innovation, and semiconductors hit an all-time high later this week. So we have this really nice marriage of innovation and growth happening across the landscape and also globally. If you look at the slide on the right, this is also from our partners at Capital Research Group. They do a nice job talking about innovation, but innovation happening globally. I think here in the US, the focus has been a lot on AI, cyber, cloud. But if you look at areas like in Sweden with Spotify, Netherlands with ASML, we look in parts of Germany, we look at parts of the Netherlands, you're going to see a lot of focus on global players trying to play catch up and not miss out on what could be almost $4 trillion of spending around innovation. So here we are at the mid-year mark. What should our clients make of it all? We've had an incredibly fast recovery. So be patient if we have some volatility. Expect volatility should start to kick in here before we get clarity on trade. Number 2, we've probably pulled forward a lot of the returns of the Fed rate cut. So when the Fed actually starts to reduce rates, don't expect the stock market to take off. That's factored in, that's discounted into the market. As far as asset allocation, we stick by our principles, combination of deep value dividend names, and those dividend names can be US or global, a combination of innovation growth companies, making sure you have focus on the bond market, which from a relative standpoint looks very strong, right? Real returns, which are getting paid minus inflation, are pretty significant compared to what we've experienced over the last decade. Then, of course, what we've really looked at in our firm is looking at bringing in non-traditional private investments, something that we're very excited about. So stay balanced, expect there to be some volatility, but the general landscape is looking positive for risk assets. I'll finish with another big item of the week, the big beautiful bill. So one of the more significant changes when it relates to personal income taxes, estate thresholds, charitable giving, taxation or not taxation on Social Security. We realize as a financial planning firm how important this bill is day to day as we review plans. So not only are we going to be talking about the impact of all of our clients, but also we're going to be sending out small videos on the many topics that are impacted by this bill. Probably the most significant bill since the 2017 tax cuts that, of course, Donald Trump was also behind. So I'll leave you with this thought, which is enjoy your summer, enjoy your family and health. You're well positioned with a wealth management team and a group of individuals that care about you. We hope you have a great summer. Reach out to us. We look forward to seeing you soon. Enjoy.